Our perception of money is changing rapidly, and banks are at the center of all of it. From how we access it, to how we buy, to how we trust that that money will be there when we need it. I'm Kia Haslett, the creator of Fintech Takes Banking. Here on Bank Nerd Corner, I talk with bankers, economists, academics, and more about the complex dynamics shaping the financial services landscape. This week on Bank Nerd Corner, I'm exploring different facets of the banking as a service space with two experts who have written a lot on the topic. Dan Awrey, the Beth and Mark Goldberg Professor of Law at Cornell Law School, and Jason Mikula, author of a book on this topic and an independent investigative journalist who publishes the Fintech Business Weekly newsletter. Dan just published a new paper, Banking Technology and Instability. Both Dan and Jason write about banking as a service from different angles. One is an academic and one is an investigative reporter, but there's a lot they agree on. We get into why regulators have fundamentally misunderstood what makes BaaS different from conventional outsourcing arrangements, and the policy proposals that Dan has suggested that will also never happen. This conversation has real implications for the public who uses these financial apps that look a lot like banks. If that app fails them, the consequences could be very different from a standard bank failure. Hi, Dan. Hi, Jason. Thanks for joining me.
Hi, Kia.
Good to be here.
Well, I am so excited to have two of what I think are some of the smartest writers and minds in the banking as a service space, and to talk about Dan's latest paper, Banking Technology and Instability. Dan, when did you start writing this paper, and what were the questions and issues that motivated you?
Yeah, the process for me tends not to start with individual papers, and this for me is my first tentative foray into a series of questions that I think are interesting that go back to the early 2000s and the impact of technology on the structure of the banking system. So the first paper to come out is the paper on banking as a service, but it has two friends. One, a paper that is going to be on the impact of technological change on community banking and the unique political space that community banks occupy in the United States, how that has tended to filter through to regulation, and how that regulation has not been particularly helpful in supporting community bank competition. And then the third paper in this series, which will, in some respects, I think, overlap with this paper, is on reimagining the Bank Holding Company Act, where it's gone through a number of iterations with a number of different theories for what it's for. But in a world where banks aren't the only institutions that do banking, activity and ownership restrictions that we just impose on banks create opportunities like banking as a service, like the entry of Mr. Beast into financial services, that manage to avoid most of the basic restrictions that we think of when we think of the Bank Holding Company Act. And so it's a one piece of a bigger pie into the impact of new technology on bank structure and regulation.
I can definitely get behind seeing a topic and needing to chunk it into different, um, papers. I often have to serialize my writing. You mentioned the 2000s, going all the way back, 26 years. Um, when did you realize, like, oh, I have enough material here to start writing, and actually now I have enough material that it needs to be kind of thematically broken into things?
Yeah, it's a great question. And I often get asked this by colleagues in the field because if you look at it positively, tend to write 5 or 6 papers on a theme. If you look at it negatively,
Yeah.
I'm never really that topical because I'm always looking back at things to find patterns that then I find interesting and want to write about. And I think in that respect, I'm still in the process of uncovering exactly how much I have to write. I currently have 3 papers in this series. The last time I did this, it was one paper on payments that turned into 3, that turned into 7, and a book. That then themselves, people won't let me stop writing about payments. And so that line of literature continues. I think I just leave an open mind. Sometimes you go down paths and it leads absolutely nowhere. Sometimes a tiny sliver in the rock turns out to be a deep vein of really interesting sort of research questions and lines of work.
Jason, does any of that sound familiar to you?
I mean, I have the problem where, once I start writing on something, even if it is a edition of my weekly newsletter, like I want to make sure I get it all in there. And sometimes that turns into, 5,000, 6,000 words, which is a lot for people to digest on typically on a Sunday morning. But as far as sort of like following a path and sort of seeing where it goes, that absolutely resonates. I mean, this specific topic that we're discussing, banking as a service, this might be hard to believe, but like I barely knew or really understood what that entailed as recently as 2021, and it was
Yeah.
only through talking with operators in industry and hearing these sort of continual, at that point, whispers of, this bank is having an issue or examiners are really giving, this other bank a really hard time. And that piqued my interest because I was like, well, I don't see anything out here publicly, and yet it seemed to be conventional wisdom that there was this huge crackdown happening behind the scenes, which of course later, you know, 2022 and onward spilled out very publicly in the form of various enforcement actions and consent orders.
So, Dan, in this paper, I was very interested in the framing device you used. You talked about banking as a service as an inversion of the traditional outsourcing model rather than a disaggregation of it. And I know banks are really, really familiar with the idea that they've outsourced so much, basically all of their technology. And they kind of go back and forth on how much do they need to own, how much can they build or buy, and what do banks really do if that's delivered via this technology? So, can you help us understand and talk a little bit about why the outsourcing model framework helped you conceptualize the banking as a service arrangements and their risks?
Yeah, sure. And I suppose part of it is that if you're a hammer, everything seems like a nail. And as an industrial organizations guy who just happens to focus on banking, things like coasts, things like the question of why we have outsourcing to begin with, the conditions under which it's likely to be efficient are just kind of bread and butter for me, to be honest. And I'd long studied, if not written about conventional bank outsourcing, especially in the payment space. And it's expanded quite a bit in recent years when you think of things like cloud computing, cybersecurity, all these technological add-ons, sort of the evolving role of the major bank tech IT platforms, the core service providers, and all of that has been interesting to follow. What I then sort of saw in banking as a service, and this is the one place, if you read the paper, Kia, you already know that I cite Jason a lot. The only place where I
At
disagree
least
with
9 times.
Jason,
At least 9.
at
I
least nine
told him.
times. The only place where I disagree with Jason, I don't think we actually disagree at all. It's just purely a question of framing. Was this it is a disaggregation in many ways. It's a disaggregation of the core bundle that we traditionally call banks into their constituent elements. But at the same time, if we view it as, well, who's the front office and who's the back office in this relationship, that's where really the inversion, to my mind, came to the fore. Because it's ultimately about consumer expectations that I'm wanting to say something here. And that's that we know our bank, we love our bank, we have no idea what's happening behind the scenes from a technological perspective at our banks. But if I was 30 years older, younger, and one of my students, it would be the exact opposite. I have my banking app that I know and love, and I absolutely have no idea whether it's a bank or not. Whether it is just a user interface that then the disaggregated component is actually all the relationships with middleware providers and the underlying partner bank, and maybe a few other intermediaries in between, Visa, MasterCard, whoever. And so the inversion is really just what the customer sees relative to what's happening in the background. It used to be that you'd see the duck swimming on the water, and you wouldn't know how rapidly it was flapping its feet under the water. Now it's the feet that are up in the air, and the duck is drowning.
So, Jason, yeah, I actually asked you to join this podcast when I did come across that part in the paper that there was a disagreement. And I was hoping there'd be a little bit more of a fight, which I don't think either of you guys are going to give me in this podcast. But you did not write about banking as a service as a outsourcing model inverted on its head, as a duck, legs flailing on the surface of the water. You said it was a disaggregation of the value chain in banking. Why did you kind of adopt that framing? And is the answer because you're not an industrial organization scientist?
I don't think I'm any kind of scientist. Um, yeah, I mean, I think, to some of the points Dan just made and that he makes in the paper, I think that you could make a strong argument that disaggregation exists within traditional banking, right? I mean, if you look at Community Bank X, it's not a fully vertically integrated operation. They have their core provider, which is probably, FIS or Fiserv or Jack Henry. They have, an issuer that they're working with for their debit and or credit cards. They, have an agreement with a network like Visa, MasterCard. So I think, you could also make that the same argument I make about BaaS as far as it being a disaggregation of the value chain. Like there's an argument that is true within banking, sort of directly within banking, without this sort of banking as a service component that we're discussing. I guess the reason why I chose that specific language or that specific lens was because I was thinking specifically about the economic value chain. And of course, when we talk about BaaS, banking as a service, it encompasses a number of different business models.
Yeah.
For the purposes of this conversation, I'm going to stick to probably like the quote unquote neo-banking business model. So, your Chime, which partners with Bancorp and Stride, for example. And so the reason why I selected disaggregation, that word specifically, was thinking about, okay, in this model where the customer facing entity, I'll just say Chime because it's the easiest and largest example, is a non-bank. The primary revenue driver is interchange from debit card transactions, and that interchange or that revenue is split or disaggregated among the players that are operationalizing that product. I
Yeah.
think to play devil's advocate, to try to give you a little fight,
Please.
um, I mean, you could make an argument that uh, the banks are outsourcing customer acquisition, user interface, and customer service to the fintechs. So, like, you could take the same sort of thing that Dan's describing, that I'm describing, and just reverse the mental model and say, okay, like I'm Bancorp, I have outsourced the job of marketing, of acquiring a customer, doing the work of onboarding that customer through an iOS app or an Android app, and then actually servicing that customer. So I mean, you could just invert the argument Dan's making, and I think it would still be true, although I don't think that's necessarily the most useful mental model for the kinds of conversations we're having about risk, about how consumers perceive these products, and about the bank regulatory perimeter.
So, do you guys think these distinctions kind of matter? I will say that I think you guys, there is a lot of agreement, there's a lot of alignment, a lot of citations. But as far as when we think about like um, incentives and risks and some of the critiques that this model, you guys have both made, is this like an important distinction, or are we just for me, when I was listening to Dan, I was like, oh well, that's maybe how an end user would think about it. But when I was listening to Jason, I was like, oh, that's probably how the bank thinks about it. Like I was like, maybe I'm just embodying both perspectives.
I think Jason is right that in his comments that it does matter where you start, right? Because I think both frames have incredible value. I don't think they're competing frames. I think they're largely complementary frames. What I was hoping to get out of my framing was really that the conventional model has some very strong economics behind it in terms of comparative advantage, in terms of contracting under terms of uncertainty, in terms of the future technological frontier and things like that. And that those same economic drivers also exist in BaaS with
Hmm.
one important exception, and that's a different regulatory framework. And that different regulatory framework then feeds into the confounding of expectations that customers risk running when they deal with the new outsourcing model relative to the old sourcing model. And so for me, that foregrounds my framing foregrounds the thing I'm mostly concerned about, which is consumer
Sure.
expectations. I will say, to give you an example of how it's fun and wonderful to switch framing, the version of the paper where I'm reimagining the Bank Holding Company Act, the framing for that paper actually jives really well with what Jason just said. The framing for that is the Bank Holding Company Act is about who owns the bank, when in the modern world, the question is who owns the customer? And that's the thing that the BHA does not get into at all. It doesn't understand, but that BaaS, the Mr. Beasts of the world, understand perfectly,
Sure.
because that's what drives their business model and the underlying economics.
Oh, and I think what's interesting and perhaps in a sense confounding about like the current legal structure that most BaaS programs or most fintechs operate on in at least in the deposit account and debit card kind of scenario is there typically is a direct contractual relationship between that end consumer and the bank. You know, there is a DDA agreement
Yeah.
that that person or business has entered into with the underlying bank, and the legal lens, and I suppose by extension the regulatory lens, is the fintech, the company that a person is interacting with, at least legally speaking, is acting as a service provider to that bank.
Yeah.
Now, is this a good way to organize it? Has it been effective at mitigating risks and protecting consumers? I think there's ample evidence that the answer to that is probably no, or not enough. But I'm curious to hear Dan's opinion on that.
Well,
No, I
actually,
mean,
oh, sorry.
no,
Go
Kia, you
ahead,
go.
Dan.
I was only going to agree with Jason, so I can
This
do
is
that
not
very
I know
efficiently.
you guys are nowhere close to the amount of arguing that I was hoping would ensue on this podcast. But no, so both of you guys have written about regulation and the kind of the legal framework that underpins these economic outsourcing value chain relationships. So how would you guys describe how regulators have approached and responded to banking as a service under your frameworks? What's is if there's anything that you liked, what did you like? If there is one thing that you wish had been different, what like the biggest thing that you wish had been different, what would you say? So Dan, I'll start with you.
Sure. So, uh, as a descriptive matter, the two things I would focus on are one, the enforcement actions against partner banks, which in general I think are useful, although I
Okay.
worry that they're only reflective of the tip of a broader iceberg. And especially in the wake of Synapse and the fact that Evolve in particular seems to be still doing a fair bit of business despite never really absolving itself in any way from that debacle, is a concern for me. And the level of regulatory scrutiny that it's gotten, although we can't see it all, obviously. So much
Of course.
happens behind the scenes with the pre enforcement stages that I want to give regulators the benefit of the doubt that they're actually in good faith looking into this sort of stuff. The other thing you can see is the intellectual imprint of what regulators think banking as a service is. And there you look at something like the interagency guidance, where I think, and I know you've got questions about this as well, where what I see are regulators who don't get either Jason's framing or my framing.
What
And
what
as a
framing are they
result,
using?
I think they're using a framing that outsourcing is outsourcing,
Okay.
and that the direction of the outsourcing doesn't matter. And of course, that's exactly where my paper intervenes, is to say that actually, from a regulatory perspective, the direction of the outsourcing matters completely. It dictates consumer protection, it dictates the application of any number of federal banking laws, ultimately. And then the thing that I thought I was missing, I have to say, and when I was looking at this maybe a few years ago, this wasn't at the front of my mind, but like so many people, Synapse just accelerated my thinking on a lot of this, is
Yeah.
the enforcement of advertising in the BaaS space. There are just so many examples where there's just really egregious marketing practices. And they're egregious to me, particularly because every statement in the marketing is correct. But when you
Technically.
put them all together, they're designed to create an impression that is the exact opposite of the legal reality of depositor protection. And that to me is really concerning. That to me is something that I've been following after Synapse, and it
Mhm.
hasn't changed. There's no change in the FDIC's approach to marketing, as far as I can see. And responding to that, I haven't seen a perceptible change in the advertising that fintech platforms with FBO accounts actually use. And so that to me is a big missing piece in all of this.
Jason, do you want to respond to that? Have you been covering the logo FDIC disclosure?
The FDIC disclosure, but also in Dan, I think alluded to this earlier. And this, I apologize because I know this is like incredibly pedantic, but the difference between bank and banking. I mean, I'm sure that avid listeners of Kia's show will probably recall Chime got in trouble
Yeah.
with the California DFPI, and I think also the Illinois, I forget, IDFPR is the regulator there, for using language describing itself as a bank or the URL, like the web address chimebank.com, something like that. And so it's like, I mean, even for people in industry, like the difference between, okay, I can't call my thing a bank because, I mean, legally it's not a bank, but I can say I provide banking. So the gerund, I guess, is okay, but using the noun is not okay.
It's both the
Um,
specificity and then the impreciseness of English language that we just don't have another word that works for so many people's minds. But obviously, once you use that verb, people definitely just assume it's coming from the noun that it shares the root with, right?
It's also, I don't think this is pedantic at all because it's unique in the English language that we do this. I don't do doctoring, right? I don't do lawyering unless I'm a doctor or a lawyer. But apparently, I can do banking when I'm not a bank. And this goes to the heart of the consumer expectations because the marketing, what do we know about banking at the end of the day? What does the average consumer who doesn't listen to Bank Nerd podcast yet actually know about banking and what they expect? And it's that little plaque on the desk. It's that logo that says, the reason I'm putting my money in a bank is because it's FDIC insured. And surely things that are providing me with banking services must be required to do the same thing. And it's the linguistic connection, it's the cultural and contextual connection that is then the thing that the advertising is preying on. It's making you look and feel as much like a bank as possible without using the magic B word as a noun. And that is, on one hand, pedantic, but on another hand, the epitome of manipulative practice, in effect.
Uh,
well, and I think the way I like to illustrate this, and I should really like run this as like a structured survey or experiment at some point. But if you put Cash App and Venmo, uh, Chime, and Vero in front of a consumer, they probably think all three of those are the same thing,
mhm.
when in fact they are three distinct things with, as Dan talks about in his paper, potentially very different levels of protection as far as deposit insurance goes. If the, in Vero's case, bank, or in the other cases, underlying banks holding those deposits were to fail, the actual protection that user has is going to be very different if they're at Vero, where they have a direct account on Vero's core system, versus if they're at Chime, where their money is presumably in an FBO account where pass-through insurance may
May.
apply, if may apply, may be eligible, if appropriate records, accurate and appropriate records are kept, versus Cash App and Venmo, where those ones may not actually be insured at all.
Um, I would like to just say my one pedantic anecdote while we're on the topic of language real fast is I started my career at SNL Financial, which is not a bank. It is a data service provider. And SNL, and I had actually assumed that the company started before Saturday Night Live, because why the hell would you name your company SNL if Saturday Night Live exists? And I was told that that's wrong. Saturday Night Live was established 1 or 2 years before SNL Financial. And then I was like, but so then why are we SNL? This is so stupid. We're not like Saturday Night Live Financial. And someone said it's because this savings and loan, it would be an ampersand instead of an N. But SNL Financial couldn't use the ampersand because that would be indicating that we were a financial institution. And I don't know what regulator told Reed Nagel to do that, but that's why that's the very stupid story around why it was SNL Financial. And as if anyone signing up for a subscription to SNL Financial would be confused about the deposit taking, which we didn't do. But anyways, so what I'm saying is someone cared once, as far as I can tell, someone cared once. Maybe it was the Office of Thrift Supervision.
I now feel extremely old because I knew exactly where this story was going because I remember it. And it's actually federal law. No regulator had to say anything. It's holding yourself out with a business name that confuses you with an insured depository institution is itself not
in name
permitted.
only. It's not like people would open an account at SNL Financial and then be confused about the products and services we were selling. It's just the name. I mean, it's a stupid name. It was a stupid name either way.
In any state, when you go to register that business name or the corporation, they're going to know that there's a list of words that they can't use.
Yeah.
And S and L is one of them.
Sorry, Reed Nagel, you would have loved banking as a service. Jason, you did not answer my question about what you liked regulators have done and what you wish they had done differently. And then I wanted to ask you about enforcement actions since Dan had mentioned them.
Yeah, my answer to your question is going to be a little bit specific and personal, but during the prior administration, I actually had the opportunity to meet with then acting comptroller Sue several times, and it was always my impression that he approached, his job in general, including the topic of banking as a service and bank fintech partnerships, in a very thoughtful, nuanced way, understanding that there could be benefits as far as, this is a cliche, but there's a reason it's a cliche, quote unquote, expanding access and inclusion, so benefits on the consumer side, as well as potential benefits on the bank side. Dan mentioned community banks earlier. Nearly all of the banks that play in this partner banking space are sub 10 billion. Obviously, there are reasons for that. But I really appreciated that acting comptroller Sue sort of approached this topic in a balanced way of understanding potential benefits and, of course, potential risks.
Yeah.
Conversely, and Kia, I think you'll like this one. As far as what I disliked, I think the polar opposite was FDIC Chair Grunberg, who really, I should caveat, I have not ever met, but really seemed to want to just turn back the clock or freeze things in time, particularly when it came to his failed attempt to roll back the broker deposit rule. Yeah, you knew I was going on broker deposits.
Oh, so good.
Which had been finalized under prior FDIC chair and Synapse bankruptcy trustee, Yelena McWilliams. One more additional thing that I guess disliked or wish had been done differently. I really think the regulators could have been more proactive here. So, for example, as I was preparing for this, I was reviewing some of my prior writing on the topic, and Lineage, which was a partner bank to Synapse, when it first entered the BaaS line of business, it had $27 million in assets.
Nice.
And that was at the end of 2020 or the start of 2021. Within a year, it had basically 4x'd, so it was almost $100 million asset. And by the end of 2022, it was nearly $250 million in asset.
Great.
Now, obviously, those are still, in the scheme of banking, small numbers, but incredibly rapid growth that presumably should have caused Lineage's regulators to ask the question, how are you driving this growth? I'm speaking about assets, but then where are the deposits coming from? And, what are your relationships with the companies that are bringing you those deposits? And I have no idea if those questions were asked, as Dan pointed out, there's a lot that happens in the supervision process that is confidential that we don't know.
Hmm.
But one has to wonder, like, were those questions asked? And if they were asked, why didn't they help uncover what we now know to be the very serious problems that metastasized into the Synapse disaster?
Yeah. And so you've also written a lot about enforcement actions. And Dan said that that was something he liked from regulators. What what was your sense, and we actually don't see that many enforcement actions being awarded today. The question is did we get all of the bad behavior at the BaaS banks, and there's just no more BaaS banks to award them to, or is maybe something else afoot after the administrations have changed? What has been your sense around enforcement action activity, the violations and the severity that regulators found, and then what was driving like regulators' focus when they went into these banks and then subsequently awarded the enforcement action?
I will do my best to answer the various pieces of that come to mind. I mean, again, there are different lines of business. So, I mean, I roughly categorize it as like bin sponsorship, deposit gathering, so like DDAs, lending. And so the types of enforcement actions, there is some variance based on what lines of business a given partner bank was participating in. I think in Claros has or put together a really good sort of like chart breaking down the different topic areas within the enforcement actions that various partner banks received. Um, I think like the two most common ones, and I'm very shocked we have made it this far without using the phrase TPRM, third party risk
Oh, we're
management.
about to get there. Don't
Yeah,
worry.
okay.
It's on the outline.
I mean, the two most common were third party risk management and BSA AML
Sure.
related deficiencies. I think a lot of the orders, unsurprisingly, also mentioned like board governance. Um, and sort of thinking about like, okay, if you're a bank playing in this space, like, and through the regulator lens,
Hmm.
uh, the fintech programs are functionally and legally extensions of the bank. If you're the board, you should be thinking about how these entities are carrying out whatever the bank's strategy is.
Sure.
And, in some cases, a bank like Evolve had more than 1,000 programs. Like, to what extent did any, single individual program specifically align with the bank's, overall strategic plan? And when you have 1,000 programs, it boggles the mind that you're actually sort of doing appropriate due diligence at that sort of point of entering into a relationship and then doing the ongoing TPRM that I'm sure we're going to talk about more.
Well, Dan, you had mentioned the interagency guidance, and I feel like we got so many on third party risk management. And you said you didn't like that. And Jason was just talking about, this third party risk management that would come up in the enforcement actions and the framing, right? That the regulators would task the board with this third party risk management, but it's almost, again, does this even work in your outsourcing model? So you wrote in your paper that it's basically useless. Was the problem the guidance itself? Was it the enforcement of the guidance, or is it a secret third thing that we need to talk about?
I think it's a secret third thing for the most part. So first, although it really is all of the above. The latest iteration of the guidance made it pretty clear that the federal banking agencies didn't view BaaS as anything different than conventional outsourcing relationships, right?
Right.
And I think whether you're a fan of Jason's frame or my frame or some other frame, it's hard to really intellectually get your head around the idea that there's just nothing to see here. This is just the same. And one of the reasons for that is the spectacularly obvious reason that the guidance doesn't address, which is that all the enforcement actions related to TPRM happened against banks. Why? Because banks are the
Yeah.
only people you can bring the enforcement action against in the current model. And if you think that that doesn't make BaaS different, I honestly don't know what to tell you. Especially in the wake of Synapse, this is it's a financial network, but it's obviously a complex and difficult to operationalize set of technological networks as well. And to hold banks responsible for an area that these outsourcing arrangements, either de jure or de facto, give to the synapses of the world or the fintech platforms of the world, is to make the banks responsible for something that they don't have full insight, control, or expertise over.
Yeah.
To use Jason's example, which I think is great, the board of the bank that has that is servicing 1,000 platforms can't possibly be the only set of decision makers that we want to incentivize to make sure that this ecosystem works properly. And so, if you think BaaS is just like regular outsourcing, you're going to miss all of that because you think that the bank and the bank's board are the ultimate decision makers and the ultimate controllers. The other thing that you miss that I think is then clearly missed from the guidance is that we've just switched the regulatory frameworks. This goes back to the pedantic, not pedantic point earlier that if I'm a customer facing a bank, I have a certain set of rights and protections. But if I'm a
Yeah.
customer facing a banking app, I may have a wide range of different protections, maybe none of which approximate the protections I would have if I was using a bank noun and not banking verb. And
Sure.
that seems really, really arbitrary, putting aside the actual operational and technical differences in the outsourcing models.
Yeah. Oh, Jason, what were you going to say?
So this may, I suppose this is a little like orthogonal to the guidance itself, but I do think it is very relevant that the large majority of these fintech programs are venture capital backed. So Dan, I believe earlier in our conversation mentioned incentives, and thankfully I no longer thankfully I no longer work for a venture backed company, but I have, and the overwhelming incentive is to grow quickly so that you can go and raise more money so that you can keep operating and ideally growing and building a business. And that I think can be misaligned with the incentives or the preferences of the underlying regulated institution. So, not that there was anywhere in that interagency guidance that it talked about VC-backed companies. I'm 99.9% sure there was not. But I do think, as far as thinking through how and why these relationships tend to work the way they do, and on occasion, blow up disastrously, like the incentives of the customer facing entity is one reason. I mean, Kia, I think I'm sure you read my recent reporting on Bolt.
Yeah.
In Bolt, I mean, the people who are using that app, I don't think there are many of them, but they have or may have an account at Midland States Bank.
Right.
If Bolt were to fail or go bankrupt, like, is there any plan in place to make sure that those users have continuity of service, that they're able to get their deposits back if they have deposits in a timely manner? Presumably, Midland should be making sure that is the case. Like,
Yeah.
they did not respond to requests for comment, for the record. But like that, the misaligned incentives and the potential financial inviability of the
Hmm.
consumer-facing company is a huge risk that I mean, I'm curious if Dan is aware, but I'm not aware of any specific regulatory guidance that says, hey, if you're a customer-facing fintech and you are not profitable, like how should you manage that risk if you're the fintech, if you're the bank? Like, I don't know.
Yeah, there's a few things that are smattered at the state level effectively that touch upon some of this in terms of business continuity, but not business continuity around regulated activities per se, more
Right.
keeping the lights on. And I couldn't agree with Jason more. Can you imagine 5 words that are less likely to describe traditional bank managers and regulators than move fast and break things? Um, it's not just incentive; it's cultural.
Right.
In
Absolutely,
effect.
100%. 100%.
So, Dan, your paper had 4 policy options that you came up with. Can you briefly describe the 4 of them, and then tell us which one you think is both achievable and would make a difference to the situations we've talked about?
Sure. And the first thing I'll say is that in the current environment, absolutely none of them are achievable. This paper could
That's
hardly be
awesome. Yeah.
less timely from a policy perspective. Um, I've been very glad that Senator Warren's office has been, keeping the home fires burning in terms of trying to keep banking as a service somewhat in the policy spotlight in Washington. But whether we're going to see any moves at all under this administration, I think is even the most optimistic person is going to say we're just not going to see anything. But the 4 sort of proposals that I have, which are not alternatives, most of them I think are complements to each other. One is to resurrect the FDIC's proposal in the wake of Synapse to have better, more seamless reconciliation.
Yeah, hell
Now,
yeah.
I wasn't a big fan of the FDIC's proposal because, as somebody who is in technology in the 1990s, it sounded like it was coming from the 1990s. It sounded like some people who were thinking that a whole bunch of COBOL developers were going to get into a room and hammer out some protocols that then meant that some information on one set of tapes in a basement somewhere managed to make it themselves to another set of tapes. So we can really only do reconciliation on a periodic basis, lest we
Right.
overload our essentially pre-API technology systems. And that's where I think that the FDIC could have been much more ambitious in terms of what it required in terms of reconciliation. And of course, the more ambitious you are, the far less likely it is, one, that you're going to have synapse type problems. But two, if you are using an FBO model, it also makes it far more likely that the reconciliation is going to be sufficient to allow the rapid disbursement of money to customers.
Yeah.
And so that would be number one for me. I think that would largely be incomplete, though. I sort of alluded to my second proposal, which is look, BaaS is a partnership. And at the moment, the regulatory framework holds one side of that partnership accountable through regulation and potential enforcement actions, and one side not so much. And not only that, but it's the side that's not regulated that is most likely to be the source of potential weakness within these systems. No offense to the software programmers creating these systems. I'm a big proponent of everything, well, most of the things that are being done in this space from a technology perspective. But there's a reason that we have regulation when it comes to people's money.
Right.
And that's something where, especially in light of the incentive and cultural differences that we were just talking about, having the stick of supervision and regulation and the threat of potential enforcement, I think can be very clarifying in that regard. So I would propose joint and several liability for fintech platforms and partner banks, middleware providers if they're in the ecosystem as well. And then the other 2 sort of policy proposals that I put forward, one is the wonkiest of wonky policy proposals, but for people who know me, people who follow folks like Morgan Ricks at Vanderbilt or Howell Jackson at Harvard, is finally getting around to beefing up and making relevant the illegal deposit taking provisions under the Glass-Steagall Act, actually giving some enforcement teeth to people who go around creating deposits that exist outside of the regulatory system. There's lots of different ways we can do that, but it would be an additional mechanism basically for policing the perimeter, not just a
Okay.
BaaS, but also firms like PayPal or Cash App and things like that. And then last but not least, I think one of the great ways that the United States has fallen behind is it's kind of either banks or nothing if you're a business in these spaces. And more tailored chartering. My colleague David Zaring at Wharton has come up with a great paper on chartering options recently. There have been many of us who have been advocating for this for quite some time. But the real structural solution is insofar as regulatory arbitrage is a driver of the shift to BaaS, then having a regulatory framework that's more tailored to the unique and relatively narrow risks of BaaS would help to alleviate some of the hydraulic pressure that regulatory arbitrage creates.
Sure. Jason, what would you say to these policy proposals? And would you agree with Dan that there's no chance in any of them passing?
I mean, yes, I agree with Dan that there's no chance that any of that is going to happen, at least in the current administration. Um, I mean, starting with Dan's final point, when I was working on my book, although probably the most in-depth chapters were specific to banking in the United States, I did cover bank fintech partnership models or similar constructs in other jurisdictions. And I think, I kind of came away from it about where it sounds like Dan is thinking, okay, these, the UK or Europe has e-money institution license, not a charter, payment institution license, and it allows for a specific regulatory construct um, where those entities are not taking deposits. There are, in the UK's version, there are two options for what you do with the funds you gather. I honestly forget what the first one is, but the second one is basically safeguard them at an insured depository institution, which is what
Yeah.
everybody does.
Yeah.
And fundamentally, like as I was researching to write those chapters, I was like, this basically sounds like what BaaS does in the US, just without a specific regulatory and supervisory framework that speaks to it. So, I mean, Revolut now in the UK is finally got a bank charter, but for a long time it operated as an EMI, as an e-money institution, and it had a direct regulatory and supervisory relationship with. I guess that would be either the PRA and or the FCA. I forget if it would be both of them, to be honest. So I do think that, like, from a public policy perspective, like that is the approach that I would sort of argue logically makes the most sense. You know, to Dan's point, it seems very unlikely that that would ever happen. In the current administration. Um, and history would suggest, even in other administrations, because you'll recall under Comptroller, I want to say it was Thomas Curry, towards the end of
Correct. Yeah.
Obama's term, there was an attempt to make some movement towards, some kind of new charter type. And ultimately, incumbent banks don't want to see it for obvious reasons. CSBS doesn't want to see it. State regulators generally don't want to see it. And so it's like, I think there's probably, I would say, broad agreement that maybe something needs to change, but actually executing that change feels like a near impossibility, with the upshot being, I guess we're seeing just a bunch of new full service charters, deposit taking charters, plus ILCs, which are also deposit taking, and perhaps like more, in my opinion, worrisome, the trying to expand what national trust banks do, which I'll
Yeah.
be very curious to see how this experiment turns out.
Well, I will say that I have been disappointed from a regulatory perspective as far as the focus that BaaS received for a bit, which felt appropriate relative to the consumer harm we saw BaaS create. And I hate to be like this, but like we only needed one Synapse, right? We didn't need every single neobank to have a customer facing issue because Synapse was serious enough that I think um, every neobank, every fintech that it works in this space, and every bank that works in this space should take the risks that the Synapse bankruptcy showed seriously. But that's not what happened. We don't live in that world. We live in the world where this year alone, Mr. Beast has acquired a fintech that will have BaaS partnerships, potentially with children. So that's cool. And then separately, we also saw Built, which is a fintech that is kind of BaaS-y, have this very interesting arrangement where they were supposed to help facilitate people's rent payments, and then that didn't happen, and I didn't quite realize, like, what is another thing a fintech could do that could, like, massively mess up with someone's life, and then not having, like, not completing a rent payment. is one of those things. And so we saw both of those this year. So my final question to you guys is, what kind of risks do you see in, either these specific customer segments or another example that really speaks to you? And do you think it's like what we have is good enough to address those risks right now? Dan?
So I'll build on the built example because, from my perspective, the risk that's building here is, in many respects, out of sight of certainly people of my generation and major policymakers in Washington who are, if I may say so, a little more gray in the tooth than I am in many cases. And that's that when the built thing was unfolding, I had more of my students come and ask me about these questions than anything that happened with Silicon Valley Bank, than anything that's happened in the last several years. And this is a sense that I'm building that generationally, this distinction we've been talking about earlier between banking and banks is only relevant to us, that it is lost on a large cross section of consumers who are really entering the first really full-fledged stage of their life, where things like their ability to make rent payments, or rather the economic consequences of their failure to make a rent payment, are
Right.
really starting to hit home. People are entering the workforce. People are in graduate school. Generally sophisticated, economically valuable citizens who grew up in a world where their bank is the thing on their phone, not the thing on the corner of Main Street and Second. And insofar as we've failed, really, from a regulatory perspective, to address the canary in the coal mine that was Synapse, I really worry that consumer behavior is shifting under our feet in ways that we are not properly measuring, and that the next Synapse is going to be an order of magnitude bigger. It won't look exactly the same.
Sure.
But the problem with a bigger Synapse, I think, is, for me, I look at this and I'm like, well, I'm really glad that I've got my Tompkins Trust Bank account FDIC insured.
Shout
I'm
out
sorry
community
that these kids,
banking.
absolutely. I'm sorry these kids had to learn a lesson.
Yeah.
But that's a very narrow approach to this. And I think that we need to do much more to understand exactly how consumer behavior is shifting. To Jason's earlier point about survey work, how consumers are viewing what they think their entitlements are in the event that their fintech app goes bankrupt. Because I think the next Synapse could be much more detrimental on a larger scale, not just to customers, but to a certain segment of customers' trust in both the banking system, the financial system, but also then the government actors who, at least in theory, are supposed to be there to have their backs.
Jason, what would you say as far as maybe some of these examples or any others that have come across in your reporting?
So one example I've pointed to previously, as far as like the kinds of failures and consumer harm, and this is a throwback, but Rush Card, which was a prepaid card, had a botched processor transition, and this was in 2015. It's not that people ended up losing deposits, losing money. They just were unable to access it for a period of, I want to say it was like several days, maybe a week.
Okay.
And I know this is shocking. Companies were actually held responsible. Collectively there was 10 million in restitution plus a $3 million civil money penalty, and that was from the CFPB, which obviously our current CFPB is not going to do anything. And then there was also a class action. So I mean, the reason I bring that up is that is an example where the level of consumer harm, is arguably orders of magnitude less than what we've seen in Synapse, where
Yeah.
there's still as much as $95 million unaccounted for. And while Evolve has faced a wide-reaching consent order, you know, that did not involve any financial penalty. It did
Hmm.
not involve any restitution to impacted customers. The CFPB is allegedly cooking up, what I refer to as a bailout, tapping the civil penalty fund to make consumers whole, but there's no indication of if or when that'll actually happen. As far as what I'm most concerned about, and Dan talks about this quite extensively in his paper, is undermining trust in the banking system. I think Americans, including, by the way, including American policymakers and professionals who work in financial services, I think take for granted the level of trust that consumers, that all of us have in the safety and soundness of the banking system. That is not the case in every country around the world.
Right.
I'm joining you from Mexico at the moment. There's a whole plethora of reasons why about half of Mexican households don't have bank accounts, mostly because of tax avoidance. But in countries that have experienced widespread banking failures, which it is admittedly a bit hard to separate that from currency. Currency stress or currency issues. But in countries that have experienced these, which are often intertwined, when people lose trust in the banking system, they hoard cash. They spend their life in cash, hoard cash at home, and or in the case of countries outside the United States, currencies that are not their home country currency.
Right.
And so the trust that people have in the American banking system is an immense asset that, as Dan lays out in his paper, there's a huge legal and regulatory framework that supports that: supervision and enforcement, lender of last resort, Fed discount window, FDIC insurance, and so on. And I share Dan's concern that, like, if what we're seeing, this evolution or this dispersion of like what it means to do banking really does risk undermining over not today, not tomorrow. But I've talked to some of the victims of Synapse. What they tend to say, and I'm sort of simplifying and compressing, but what they tend to say is like, I would never use a fintech again. Like, I'm going to go walk down to Community Bank and Trust, and like that's where I'm going to put my money, because Yada all over its website in size 72 font said FDIC insured,
Right.
and yet here I am 2 years later, and I still don't have my money.
Yeah. Yeah. Well, thank God we have stablecoins. And community banks. So because when banking as a service, runs into its next crisis, one, I trust both of you will write very interesting things about it. But two, we have places to put our money. But thank you, gentlemen, so much for joining me today. I really appreciate it.
Thank you, Kia.
Thank you, Kia.
Thank you for listening to this episode of Bank Nerd Corner. Stay up to date with news and trends in the bank space by subscribing wherever you get your podcasts. Also, if you love FinTech Takes Banking, please tell a friend. Talk to you next time.